So yeah, gold, let's zoom out first to know just where we are in a bigger context. Looks like Bitcoin. Yeah, so where do we have the big levels? And this is the weekly chart. So if you say that you trade maybe the 4 hour, the 2 hour, do you really need the weekly? I don't think so too much. You at least, the only thing that maybe is interesting, you just want to see, okay, where is the market right now? Do we have a big level? And in this case, we do. So, and now later I have to change it all back. So yeah, you can see it. I think here a lot of orders. The price has not really made it that much through the level, but if the market will come back, yeah, it actually almost made it. Here's a supply level weighting. Why is this supply? You can see this caused a huge drop, even initiated this breakout here. So this is a very, very important one. And that's really all you need probably from the weekly. Anything else doesn't really make any sense. You can look maybe for the pattern, because in this case it's quite interesting. You have an engulfing bearish candle, which is quite good. Two, I think you call it tweezers, where you just have two rejections, which is interesting, but that's it. And then on the 12 hour, what do you have? You have an incomplete pattern, I think, here and here. And now this is annoying. So yeah, you have here a decent support level, nothing that I would get super excited about. What I would like to see is let the market validate the level here a little bit and then move lower. So yeah, and this is usually, and this is what you do with trading plans. Or what, at least what I do, I think about, okay, what could happen? The market could make a bounce, which I would really, really like. If the market breaks out directly, would I like this? Probably not as much. I don't like those direct breakouts. They're just harder to trade. You can trade them, but they're a little bit harder. Another option would be break and retest. So we already have 3 options now for potential short. First, we bounce. Second, the direct breakout. Third, the retest. So okay, this is what I will write down, or what I will keep in mind about my trading plan, what is possible for gold for the short side. And then I can just ask myself, okay, how do I want to trade the breakout? How do I want to trade if the market bounces? How do I want to trade the pullback? Obviously, this would go much, much beyond this webinar to cover how I enter every little trade. This is really something only for the masterclass, but I think this is already giving you a good idea, because you need to ask yourself, okay, what could happen and how do I respond to it? Those are the options for short. If the market keeps bouncing left and right, up and down, what am I going to do? I'm going to do nothing, because I don't like to trade within ranges. So, okay, the sideways phase I have covered. I'm not going to do anything. I'm prepared to, whatever happens out of the 3 short scenarios, I know what I will going to do. And well, for the long side, ask yourself, okay, am I a breakout trader? And am I a continuation trader? I don't personally like those late breakouts or late continuations. So if the market continues to move higher here, I probably will pass on this very, very happily and not get involved. What I would have liked, or what is pretty much textbook here, and this happened the same way in silver, is that we had here this transition. We have here the market telling us how's the market moving. We have higher lows, and then the strong breakout, immediate retest. This is something where, okay, I would have joined and I would have traded this to the long side. That makes sense, because the breakout is happening very, very close to the origin of the pattern. But right now, if the market breaks out here, I feel this is too overextended for my taste. So I'm not going to trade long. I'm not going to trade sideways. But if one of those 3 short setups happen, then I might consider, depending on how it happens, what are the circumstances, and how is the price action behaving in reality once it happens. Oh, that's a good question. How many pairs do you recommend a beginning trader? Sorry. And I think this is I think I answered this in my last video on YouTube. It really depends on what type of trader you are. Are you a day trader or are you a swing trader? And the answer will be totally different for whatever path you choose. If you are a swing trader on the higher time frames, and I consider higher anything above really 2 hour, 4 hour and above that, then you should probably choose a lot of Forex pairs. So you can see here, again, probably around 30 Forex pairs. I'm not trading all 30 Forex pairs every week. You can see some have flags, some have different color codes. But I will probably trade or have in my inner selection out of those 30, 10 probably go to my inner selection for the next few days. And then usually I end up with anything between sometimes just one trade per week, but usually across 2, 3, 4, 5 trades per week. But as a swing trader, you really need to focus on many, many more pairs because, as I said in the beginning, the market will move slower. So you have fewer candles, patterns will take much longer to develop. If the market is not favoring your system, then it will take longer until the market gets out of this cycle. That is something you need to consider. As a day trader, I think you can get away with focusing on maybe just a few pairs. That's what I know Moritz did or does. He doesn't trade all the pairs, but he's focused on a few that look perfect. And yeah, on the 5 or 15-minute time frame, a trend will go over quickly, patterns will emerge and go away very quickly. So you don't have this big waiting aspect, if that makes sense. How do you deal with correlations? I use correlations, or well, I look at correlations in my risk management or my position sizing. So let's say we can do that together. Maybe that's nice. So let's say I take a maximum per trade of, let's say, 2%, and then I have a trade set up on the euro US dollar and the British pound US dollar. And let's say they are very positively correlated. So you cannot trade 2% on the euro and you cannot trade 2% on the British pound US dollar, because what will happen is that they have a very, very high likelihood of having the same outcome. So what you're doing is almost doubling your risk and having and running a high probability that the outcome is the same. So if a correlation is completely 100% positive, this would be considered as just one trade of 4%. This is not good. So what I usually do is that if I have a setup on correlated markets, I take 1 and 1, and then that's more or less like 2%, a little bit less probably, because the correlation is not perfect, but that's usually how I factor in. So I know my maximum position size, and then I look at my trades and my setups that happen. Are they correlated? Are they very, very correlated? If they're not that correlated, what I will do is that I take 1 and 1.5 and 1.5, and then you still have a decent risk without increasing the risk too much of running the same trade. Questions on targets. Do you use multiple positions? No. Do you set targets? I manage these positions typically. How do you set targets? I'm very lazy when it comes to targets. And this has been sparked, this laziness, after I get involved into algorithmic trading. In algorithmic trading, what is really interesting is that you look at your entry and you look at your exit as completely different things. They have nothing to do with each other. For the most part, obviously, but it's interesting to see that you can treat those very, very differently. So I ran many tests, and I found that for me, I just put my stop loss where it needs to be put based on chart context and all the rules. And then I use just a 3-to-1 reward to risk ratio I don't care where it is in market context. I don't look left. I don't look for support resistance anymore. I used to do that, but it's just a 3-to-1 right now. And 3-to-1, who knows what is the minimum required win rate for a 3-to-1 reward to risk ratio? I know my students know it, but what is it? Win rate to at least break even. The win rate is, there's no maybe in math. Minimum. No, the win rate. How often do you need to be right to just break even if you have a 3-to-1 reward to risk ratio? Yay, Thomas. Yeah, so it's 25%. And who think you can trade with 25%? Do you think you can trade 25% or better? You don't need a win rate with 80, 90%, 70%, 60%. Of course, it's nice to have, but it's not required. And I think this is one of the most important things a trader needs to realize, among so many other things, obviously. But alone looking at this and looking at, okay, if my trades have a 3-to-1 reward to risk ratio, I only need to be right 1 out of every 4 trades to break even. Obviously, considering commissions, maybe this will be a bit higher, but in general, this is the beauty of trading a higher reward to risk ratio and knowing about win rate. And then you don't need to really bother about every single losing trade because you know, okay, only 1 trade will pay for 3 losing trades. And that is then when you can have one of those nice aha moments when it really sinks in.